Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, I want to distinguish between several different types of interest rates and how they impact our bottom line. So let's get into it. There are three main types of interest rates, and a lot of times we tend to collapse one interest rate into another. And so there's a lot of confusion when you hear this interest rate going up versus that interest rate. So I want to quickly define what each one is and how it affects our bottom line. I'm going to start with the federal funds rate. This is the one that's been in the news a whole lot because the Fed funds rate has been raised several times over the last couple of months, and it's catching a lot of media attention. So what is the Fed funds rate and how does it impact you? First off, the Fed funds rate is critically tied to the U.S. economic outlook. It directly influences the prime index rate, which we'll talk about in just a few minutes. And basically, it's the interest rate that banks borrow money from banks. It's called the overnight rate. It is controlled by the Federal Open Market Committee, and they basically help steer where that rate goes so they can slow or speed up our economy. So the Fed started raising this interest rate in March of this year, 2022, for the first time since 2018. And prior to them raising it, it was nearly zero. At the time of this recording, it is currently 2.5%. So I'll give a little history over the last couple of decades. From 2004 to 2006, the Fed raised the interest rate 17 times from 1% to 5.25%. The reason being is they were trying to slow down our economy. So when an interest rate goes up, it typically slows down borrowing because the cost to borrow increases. If the economy is growing too fast and inflation is starting to heat up, it's a way to curtail spending and borrowing. So the Fed stopped raising that rate because we had experienced the Great Recession. So this interest rate was virtually 0% from December of 2008 until December of 2015. Then the economy was getting hot again, things were feeling good, so the Fed needed to slow things down a little, and they started raising those rates steadily until 2018. In 2019, the Fed actually reversed course. So the rates were going up steadily, and then they started slowly lowering those interest rates to counteract a weak economy. And then as we know, in the last couple of years prior to March of this year, that interest rate was near zero. We are anticipating the Fed to raise this a few more times over the next year and a few months, up to 2024. So when this rate increases, the cost to borrow money increases. The flip side, the positive side, is that you'll start seeing interest rates on like savings accounts and money market accounts increasing, albeit it'll be just a little bit. I mean, who can get excited about 2% on a money market account when inflation is nearly 9%? Okay, so that's the Fed funds rate. And this interest rate has a direct correlation with the prime index rate. So the prime index rate is basically overseen by 10 of the country's largest banks. So the CEO for Chase and Bank of America and Wells Fargo all call each other when the Fed raises their rate, and they agree to match their rate. So at the time of this recording, the prime index rate has now gone up to 5.5%, and it has raised equally as far as percentage every time the Fed raises their Fed funds rate. So the prime index rate is what auto loans, credit card APRs, and home equity lines of credit are established on. So every time that raises, credit card APRs go up, auto loan interest rates go up, and home equity line of credit goes up. Now, what's important to know is that the interest rate on a fixed auto loan cannot go up if you've already got that existing loan. This would just be for offerings on a new auto loan. Typically, auto loans are a fixed interest rate on your loan, but home home equity lines and most credit cards are variable interest rates. So what happens every time that prime index rate goes up, your interest rate on your credit card, if it's variable, and your home equity line will typically increase to match that rate increase. If you listen to one of my earlier episodes about APRs on credit cards, those credit card companies will send something in the mail stating that the APR is changing, and nobody ever reads that. But what you're going to find is your minimum payment will increase, and the amount in interest that you're paying on any balances that you roll forward will also be increasing. Okay, so let's dive into the third interest rate that I'd like to talk about. Interest rates on long-term mortgages, so 30-year mortgages, which is the most common fixed rate term that people take on a home loan, is attached to and follows the 10-year Treasury bond yield. So this U.S. Treasury 10-year yield is used as a proxy for important financial matters such as mortgage interest rates. So this is a bond. It's sold at auction by our U.S. government, and it tends to signal investor confidence. At the time of this recording in August of 2022, it's currently sitting at 2.77. And interest rates tend to be in the fives. In June, when it was above 3.49 at one point, interest rates were touching 6% interest. And just to give you an idea of where we were 1 year ago, the value was 1.31%. So it's more than doubled since 1 year ago, which helps explain why interest rates are higher current day than where we were in 2021 and in 2020. So when you hear that interest rates are changing or interest rates are going up, it's important to pay attention to what rate someone is talking about because each one affects something a little bit differently. But the overall theme that we're experiencing right now is it's just more expensive. And I hope that you understand a little bit better now what's happening in our current financial landscape because everything is going to continue to cost more. Those credit card companies have to send you that disclosure about the interest rates going up, and they can't increase your rate until 45 days after mailing out that disclosure. So if you carry a balance on those credit cards, my words of advice, get that down as soon as possible because you're really going to experience a squeeze with higher interest being charged on that outstanding balance. If you currently have a home equity line, prepare for that payment and that interest rate to go up. And if you're going to be borrowing money soon for an auto loan or a personal loan, be prepared for those interest rates to be a little bit higher as well, since the overall cost to borrow money is going up. Thanks so much for listening. And if you have questions, feel free to reach out to me at questions@creditchristie.com. I'd love to connect with you on social media @creditchristie. And until next time, my friends, stay well.